Hello, this is Brian Lysing with Financial Brokerage, and today I've got a question that you can ask your clients that should lead to some larger life insurance sales. So here's the question. Why are you paying your 401k plan manager to potentially help you lose money? Now, where am I leading with this? Well, we do a lot of discussions with Index Universal Life, and usually those revolve around the tax advantages or the lack of a chance of losing money. But I want to talk a little bit about the expenses in various retirement plans. That's something we don't usually touch on. So I wonder if your clients are actually aware of what their 401k plan actually costs. And I'm using 401k plans because for the majority of people that have retirement plans, it's a 401k plan through their employer. Now, I'm not saying that money managers and the administrators shouldn't get paid. Obviously, they're providing a service and they should be compensated for what they do. But you want to look at exactly what you're paying and what you're getting for that. So as an example, I reviewed a retirement plan, a 401k plan with a client a couple of years ago, and looked through their quarterly administrative charges. And for this client, that came to $352 for that particular year. Now that's probably not too bad, but we also looked at the expense ratios, the average expense ratios for the sub-accounts they had. That came to 1.06%. On average, they paid $1,378 that year. So for the entire year, they paid $1,731. Now they only put in about $6,000 the entire year into that 401k. So $1,700 out of $6,000, I think, is a pretty high percentage of their money that's going to expenses. Now, what did they get for that? Well, you know, if they got a 15% or a 20% return, hey, that's fantastic, right? Well, they didn't, though. Their rate of return, on average, since inception of the 401k, at that time was 5.67%. Now, if you're going to write a check to a money manager for $1,700, wouldn't you expect to get better than a 5.67% return? In my opinion, I would think so. So what's our alternative? What can we offer to our clients in this situation? Well, you might want to talk to them about an Index Universal Life policy. Now, there are still expenses in life insurance. We've got administrative expenses, policy fees. We've got the cost of insurance. That might be the largest expense over time. So I ran a detailed illustration. I looked at those, and I looked at the expenses in years 1, 10, and 20. And on average, with just those 3 sample years, the annual expenses were $1,000. So now we've saved the client about $700 a year. Now, what did we get for that? Well, the illustrated rate of return on the index was 7.11%. Now, we're already doing better than we were with that 401k plan since inception. Remember, though, as well, that we're doing this with absolutely no risk of loss due to a market downturn. You can't lose money with an index. The worst you're going to do is get 0%. You never have to make up ground. Now, 7.11 is the greatest return that the illustration was allowed to show. Inside there, I saw some 30 and 40-year lookbacks on another index option, and those were near 9%. So we know the client could do much, much better than the 7% rate of return. So what's our bottom line here? What are we getting at? Well, if we're just, let's say we assume the same tax advantages, meaning our client has a Roth 401k or a Roth IRA, right? We're even on the tax advantages between that and the index life. We're not even going to get into the leverage your client can get with variable loans, taking the money in that format rather than just taking it right off the top. But what we end up with here with the IUL is that our client is going to get the same, or I would argue, much better returns over time in the index life. They're going to have absolutely no risk of loss, and in many cases, at least in this one, they're going to have lower expenses. Now, I can't guarantee that's going to be the case for every person out there. If they're standard rated, if they're table rated, certainly that might not be the case. But for your healthy clients, you need to take a look at this and review their retirement plan versus an index life and just see how it all shakes up. Because why on earth would a person pay a money manager to potentially help them lose money? And if so, are they getting the returns that they would expect for those fees? I would argue in many cases that they're not, and your clients would do much better in an index life policy.